And now the latest one comes from India. The country's central bank on Friday cut its benchmark interest rates by 50 basis points, twice of what was expected. Not only that, though, they lowered their cash reserve requirement for the banking sector by 100 basis points. It was shock and awe, at least it was intended to be, though officials in India downplayed the significance, saying they were only just trying to shore up confidence with their aggressive tactics, which only begs the question, well, how bad is confidence if it needs these aggressive tactics to be shored up? The answer in India is the same one being delivered everywhere, what the mainstream calls global uncertainty. But as I keep pointing out, things are becoming more, not less certain, which is why central banks everywhere outside of Jay Powell are behaving this way. We've got shock and awe in India. Mexico, multiple 50s with more coming. The ECB is already at historically low rates again. Switzerland is going to be deciding between 0 and negative rates. And on we can go. One after another central bank, which used to be laser focused on inflation risk, now just cutting as fast as possible. India, however, that's a bit of a special case. On top of economic concerns, the nation is also grappling with increasingly difficult banking conditions. The rupee system has been plagued by repeated and serious bouts of illiquidity, along with sharply lower overall loan growth, as we'll see here today. The latest figures for the latter show Indian bank loans haven't been this slow in 3 years, with a sharp downturn returning over the past few months. So RBI's head Sanjay Malhotra says the bank's just being ultra cautious, but that's what they all say at times like this. Outside of the Federal Reserve and Jay Powell, interest rates are going down a whole lot more and a whole lot more quickly than people seem to realize. And while they keep saying it's this global uncertainty pushing them to do what they don't really want to do, it's not really all that uncertain. The Reserve Bank of India, however, was one of the last to start cutting rates in this global cycle. The previous RBI governor, Das, had kept rates, he preferred to keep rates steady, trying to steady the currency, which, as we know, had been falling precipitously, sharply, especially late last year to start this year. The idea was that lower rates meant unfavorable interest rate differentials, therefore, at least according to mainstream conventions, more weakness for the Indian rupee, which Das did not want to risk. As we'll see, though, and as I keep pointing out, it's not interest rate differentials, and it's certainly not central bank policy differentials that matters for the currency, for any currency. Anyway, it got Das into trouble with Prime Minister Narendra Modi, and he basically was shoved out the door, not reappointed as RBI governor back in December. So Das was replaced by a guy by the name of Sanjay Malhotra, which was a surprise basically to the entire marketplace, though maybe it shouldn't have been. Because Modi did this once before. Back in 2018, December of 2018, he let go Urjit Patel, who not only didn't want to cut rates, Patel was actually raising them in late 2018 when Modi wanted lower rate. Like today, India's economy was performing poorly, getting weaker and weaker and weaker as the entire global economy was in 2019. There's so many parallels 2019 to today, except today in 2025, the situation is far worse than most people seem to understand, especially when compared to 2019, given everything that's happened in the 2020s so far. So since Urjit Patel was not cutting rates, Das was brought in to do rate cuts, and then he, along with the Federal Reserve and every other central bank on the planet, began lowering rates in 2019. But now Das is gone in favor of Malhotra, so the RBI began lowering rates this year in February. In fact, that made India's central bank one of the last to start in this race to the bottom, only quote-unquote beaten out by the Reserve Bank of Australia, and only by a little over a week. So their first rate cut in February was followed by another one 2 months later in April, another 25 basis point rate cut for a total of 50 basis points through April. But this time, though, the RBI went big time. A 50 basis point rate cut that was announced on Friday. And to go along with it, they also announced a staggered 100 basis point decrease in the cash reserve rate. That's India's reserve requirement, same as China's RRR, which should already be raising red flags since the Chinese never cut the RRR unless things are not going well in the economy, or more importantly, in the banking sector. Whenever these central banks and these governments resort to lowering reserve requirements, that's, like I said, a red flag, not a sign of stimulus or a sign that the government's going to fix the situation. It's a reaction, and a bigger reaction to the weakness that they're confronting. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. As always, these government, these central banks, the more they feel they have to do, the worse you know it must be becoming. So India went big with shock and all, a double rate cut plus the lowering of the cash reserve requirement. It tells you they're getting increasingly worried about the direction of the global economy, not uncertainty, but the direction of the global economy and what that might do to a fragile situation in India. The global reaction to it was just as strong as the action by the RBI. Here's the BBC, for example. India's central bank has lowered interest rates by a deeper than expected 0.5%. The third cut in a row amid falling inflation, which I'll get to, and lower growth in Asia's third largest economy. It also increased the amount of liquidity or supply of money available in the system, and that's only theoretical. That's what they always talk about. Like in China, they lower these reserve requirements, and it's supposed to unleash money into the economy, into the banking system. And it only does that if banks are going to go along with it, if they're not balance sheet constrained, which is always the key variable in any of these things. But back to the BBC. The repo rate, the level at which the central bank lends money to commercial banks, influencing borrowing costs for home and car loans, loosely influencing, now stands at 5.5%, the lowest in 3 years. And explaining the rationale for the cut, RBI Governor Sanjay Malhotra said that growth is, quote, lower than our aspirations, and the bank felt it was, quote, imperative to stimulate domestic consumption and investment amid rising global uncertainties. These uncertainties aren't becoming more uncertain, they're becoming more and more certain, which is the downside case, which is why all of these central banks all over the world continue to act and react more aggressively, like we saw in Mexico, or the ECB down at 2%, or right in the next couple of weeks, the Swiss National Bank going to zero, if not below zero. A lot of this has to do with RBI's response to the economic situation that India is in. If you remember, I've been talking about this the last couple of years. India had been the one economy that was legitimately booming during the forgot how to grow period. And it seemed like that India was going to maintain that rate, and the government expected to maintain that rate far into the future, planning to eventually even overtake China as the world's second largest to become one of the dominant powers, economic powers, not just in Southeast Asia, but around the rest of the world. Well, that ran into the forgot how to grow a little bit later last year as the Indian economy fell off sharply. The growth rate fell off sharply. They had been growing at around 9% in 2023 heading into 2024, but the fiscal year last year fell all the way down to 6.5%, even though the government is trying to target 8% in order to overtake China and to accomplish all the goals that the government has set out for. By quarter, GDP actually slowed down to 5.6% in the July to September quarter, which triggered a whole bunch of backlash. And one of the reasons why former Governor Das was shown the door was because the economy is slowing down, and he preferred to focus on the currency, which didn't even work to begin with. But then in the October to December quarter, GDP began to speed up. So from 5.6% in July to September, and then 6.4% October to December, and then 7.4% January to March. And so you're already thinking, why is the RBI acting this way if the economy is accelerating out of what seemed to be its growth scare and its downturn low in the middle of last year? Well, because RBI is still projecting 6.5% for the fiscal year of 2026, which began in what we call the second quarter, the April to June quarter. In other words, they're suggesting, like everywhere else around the world, that to start this year, the end of last year and the start of this year was more of an artificial high than a sustainable recovery. So they're expecting the artificial high to level off, and then India's economy along with the rest of the world to slow down, especially in the second half of this year. And what they don't know is how much slowing they should expect. They're expecting it to level off around 6.5%, which is already well below target and below what Malhotra said was their aspiration. But the risks are all piling up on the downside, and those risks are becoming more, not less, certain. So implicit in the RBI's aggressive move here this past week to lower interest rates and to decrease the reserve requirement, implicit in all that and this shock and awe is this acknowledgement of these downside risks, this global uncertainty, which is the primary factor that the Reserve Bank of India is now focusing on, even though beforehand they always talked about inflation, as all these other central banks around the world had done. But India has already seen sustained deflation in its consumer price numbers. Now, they usually have a seasonal pattern, but this year the seasonal pattern was even more seasonal. Favorable monsoon conditions meant big harvests, so food prices have slackened a huge amount in India. But it's a lot more than just that. In fact, you look at the CPI. The CPI in India turned negative for November, which is not unusual, again, the seasonal pattern, falling about 15 basis points on the month. But then the acceleration to the downside in December, a little bit over half a percentage point in December for the CPI, but still not necessarily atypical, still within the seasonal pattern. But then you get to January, and the CPI fell by more than a full percentage point in January alone, and you can see how it was becoming a problem. Even as GDP was going higher, a lot of GDP going higher was the slackening in prices. But either way, you could see how policymakers began to start to really rethink their situation, especially with Malhotra taking over from Das. But after January, consumer price numbers were negative again in February by almost a half a percentage point, and then negative one more time in March by around a quarter of a percentage point. So you have 5 straight months of negative CPIs, which is well above the seasonal pattern or any seasonal expectations. In fact, the last time you saw anything close to something like that was in January 2020 to May 2020. We had 4 negative months back then during the pandemic's initial lockdowns, with it broken up by actually a bigger positive in April. So even though consumer prices turned positive in April, India is coming off 5 straight months of unusual weakness, unusual deflation in consumer prices, only some of which can be tied to food. Overall, the CPI index fell by about 2.5% in those 5 months, which was enough to lower the year-over-year rate by April, which is the latest data that we have from India, the year-over-year rate to 3.16%, which is the lowest one since July of 2019. And while Malhotra and the RBI officials are trying to pass it off as just food, there's a reason why they also lowered their CPI projections to under 4% for this upcoming fiscal year. Because of the weakness in the Indian economy, they're taking some upside out of prices, and that's what has RBI really worried, especially when you get into the banking sector in India. Officials realize that consumer prices don't normally behave like this, and even if there is a food component to it, there's more going on beside it. And so they realize the more going on is worth at least trying to shock the marketplace into a major accommodation and thinking that we can get the market to move forward and move ahead if we shore up confidence with a big shock and awe move. So given that background in consumer prices, you can see where Reserve Bank of India officials are coming from. They're thinking we've got more than just seasonal weakness in food prices, so we need to do something aggressive to try to shore up confidence before these downside risks become more than just risks, become downside reality, because the downside case continues to build both inside India as well as outside. And the inside India stuff with the banking sector was as much a consideration as anything. The Indian banking sector has shown increasing weakness in terms of lending, therefore another avenue for risk-taking. According to the Reserve Bank of India's latest figures, total bank loan growth fell below 10% in May for the first time since the middle of March of 2022. It slowed down to 9.9% the week of May 16th, and then to 9.8% the week of May 23rd, the latest figures that we have. And just to give you a reference, back in the middle of January when this bout of risk aversion really began, Loan growth was still up around 11.5%, which was still well below where it had been in the summer of 2024, before things really began to slow down. So you see bank lending start to really slow down in the middle of last year, consistent with the global inflection. Again, global uncertainty becoming more certain, not less certain. And then another slowdown that began in the early part of this year, continuing right up and through April and May. And as the Times of India reported in some of the details for at least up to the month of April, bank lending to non-banking finance companies slowed sharply in April, with outstanding loans to the sector falling by a huge amount. At the end of March 2025, the growth rate was a modest 5.7%, way down from where it had been before. This was, as the article continues, significantly lower than the overall bank credit growth of 11% during the year, which was already a slowdown too, indicating a cooling in lending appetite toward shadow banks in particular. That's one of the key points that really has policymakers on edge when it comes to the banking sector, is that India has had a couple of these shadow bank boom bust cycles, and it looks more and more from the middle of last year and on into this year as if India is in the shadow bank bust part of the cycle all over again. But it isn't just shadow banks. It actually goes well beyond that. Back to the Times of India, the slowdown in credit to NBFCs was part of a broader trend. Lending to large-scale industries also moderated in April, and the share of loans to large corporates declined to 15% of total bank credit, down from 16% at the end of March of 2024. And all of this reflects risk aversion among the banking sector and the banking system in India, which means rate cuts are going to struggle to have any effect, because that's the overriding consideration for banks anywhere. It doesn't matter where they are. If risk perceptions begin to rise, and lower interest rates certainly are not going to help the banking sector want to lend more. They're going to want to lend less, because their revenue rates and their profitability rates are going to go down. Well, it's supposed to stimulate borrowing, but if banks don't want to lend, it won't stimulate anything. And that's one reason why the Indian rupee has been hanging around 85.60 to 85.70 rather than strengthening a whole lot more, along with some of the other currencies around Asia and the rest of the world. Instead, the rupee is kind of flatlined and started to become more weaker all over again. Now, it had recorded its record low on February 7th, which you'll notice the same day as the Reserve Bank of India's first rate cut. In other words, contrary to mainstream conventions and previous RBI Governor Das's fears, the Indian rupee has strengthened as the Reserve Bank of India has cut rates at the same time the Federal Reserve has maintained its rates where they are, which should be, by mainstream convention, Indian rupee negative. But before February 7th, the market had judged India's economy as slowing too much. Therefore, it was charging a higher and higher risk premium to borrow or acquire dollars, no matter what the Reserve Bank of India was doing. But once the central bank flipped under Malhotra, the market said, maybe let's give India a chance. Let's see if rate cuts might work, since there are more interest rate sensitive sectors around the Indian economy compared to, say, developed economies in the rest of the world. And plus, there's a thought that maybe India could avoid trade wars, and suddenly India may have had more going right than compared to other places like China. India was less of a total risky bet, even if interest rate differentials and policy differentials were moving in the wrong direction. The market said, okay, let's see if these rate cuts help India get back on its growth path. And if it does, then India is a whole lot less of a risk, therefore stronger rupee. But the rupee didn't strengthen all that much. Let's not overstate it and get too excited here. The rupee strengthened a little bit as the market was willing to give the Reserve Bank of India's policies a small chance to see if it worked. Because at the end of the day, the Indian rupee didn't strengthen all that much, especially when you put it in historical context. It's still closer to a record low than not. Despite RBI's policies and despite a little bit less pessimism about India's chances, not a whole lot meaningful has changed as far as India is concerned. You still have the global problems, you still have the local problems, and you still have potentially a bad mix if things continue to go in the wrong direction. More negative pressures outside, more fragility inside, and you could see where India is in. You could see why the Reserve Bank of India would react the way that it did. They keep saying it's global uncertainty when it looks more and more certain. You have slowing, even falling growth and prices to go along with it. So one after another central bank is lowering their policy rates, and some of them are doing it by quite a lot. And one after another central bank, which used to be laser focused on inflation risk, They're now just cutting as fast as they possibly can. This isn't trade wars. This isn't global uncertainty. Rates are coming down more and more and more and more places because the global economy continues sliding so much that even central bankers are becoming more than a little panicky. Now, that doesn't include Jay Powell for now, but the U.S. economy, especially the U.S. labor market, is in bigger trouble than most people are willing to give it credit for. I went over the details in a live stream this past Friday with the replay you can see below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.